Welcome viewers, let's discuss the role of inflation in your investment strategy today. Understanding the role of inflation in your investment strategy is crucial for preserving purchasing power and achieving long-term financial goals. Here's how inflation impacts investments and strategies to mitigate its effects. 1. Impact of inflation on investments. Inflation erodes the real value of money over time, reducing the purchasing power of your savings and investments. Investments with fixed returns, such as cash savings, bonds, and annuities, are particularly vulnerable to inflationary pressures, as their returns may not keep pace with rising prices. 2. Consider inflation-adjusted returns. When evaluating investment options, consider their inflation-adjusted or real returns, which account for the impact of inflation on purchasing power. Focus on investments that have the potential to outpace inflation over the long term, such as equities, real estate, inflation-protected securities, e.g., TIPS and commodities. 3. Diversification. Diversify your investment portfolio across asset classes to reduce the impact of inflation risk. A well-diversified portfolio typically includes a mix of stocks, bonds, real estate, and alternative investments to mitigate the effects of inflation on overall portfolio performance. 4. Invest in real assets. Consider allocating a portion of your portfolio to real assets that have intrinsic value and tend to appreciate over time, such as real estate, precious metals, e.g., gold, and commodities, e.g., oil, agriculture. Real assets can serve as a hedge against inflation by providing tangible assets that retain value in inflationary environments. 5. Invest in stocks. Stocks have historically outperformed inflation over the long term, as corporate earnings and dividends tend to grow with economic expansion and rising prices. Focus on quality dividend-paying stocks and companies with pricing power, ability to pass on higher costs to consumers, to help mitigate the impact of inflation on investment returns. 6. Consider inflation-protected securities, TIPS. Treasury inflation-protected securities, TIPS, are government bonds designed to protect against inflation. TIPS adjusts its principal value based on changes in the Consumer Price Index, CPI, ensuring that investors receive a real rate of return adjusted for inflation. 7. Review and adjust regularly. Regularly review and adjust your investment strategy to account for changes in inflation expectations, economic conditions, and market trends. Rebalance your portfolio periodically to maintain your desired asset allocation and ensure that it remains aligned with your investment goals and risk tolerance. 8. Stay invested for the long term. Maintain a long-term perspective and stay invested in the market to benefit from the compounding effects of investment returns over time. Avoid making knee-jerk reactions to short-term fluctuations in inflation or market volatility, as these can detract from your overall investment performance. 9. Monitor central bank policies. Keep an eye on monetary policy decisions and interest rate changes by central banks, as these can influence inflation expectations and impact investment returns. Stay informed about economic indicators and inflation data to gauge the direction of inflationary pressures and adjust your investment strategy accordingly. By understanding the role of inflation in your investment strategy and implementing appropriate measures to mitigate its effects, you can preserve purchasing power, achieve long-term financial growth, and build a resilient investment portfolio.